All right, so the markets finished off the week on a relatively high note. A very good week, and some good moves on some of these technical indicators that we take a look at that would suggest that we're still maintaining this strong bullish run that we've been on. The question is, like, when you're driving your car and you're looking at that gas tank, the question is, do we have a 3/4 tank full of gas, or do we have a quarter tank full of gas? And so that's kind of where our focus is going to be on today's video, is which one we are. We still got a long ways to go. Are we just kind of getting started, or do we have just a little bit left to go? So I'm going to break that down in our video today, also based on the different rotations and in different sectors and asset classes. And then our trade idea of the day is a stock that has been kind of stuck in its own mode, has already had its own exhale, intermediate pullback, but then the question is, can it get going again or not? So what's affecting that stock? How is price moving based on what these different charts that we look at, and then how can we trade that? So let's go ahead and get started. Today is Friday, June the 11th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, as we always do. And you can see the nice little rally we had all week long here, finishing up with a late flourish on the S&P 500. Gave us a open candle instead of a filled-in candle. We were that close to having on SPY a filled-in candle there, but we had a late little push that kept us. And you can see all the filled-in candles we continue to get on SPY over this past 20-day period. We have actually had over the last 20 days 17 gaps to the upside on the S&P 500. If you go all the way back to this is 20 days right here, and one of those three that wasn't an opening gap was about as, I mean, that was a gap to the downside to the 1,000th place. If you look all the way over here on the left, it was 0.0023. That's how much of a gap to the downside that we had from a percentage standpoint. So 20 days of gaps to the upside with only 3 in between. Really 2 down days is all we had, and 1 really, really flat day. So 17 gaps. And then you can see up here to the top that all these gaps, especially these last, I don't know, however many, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10 gaps, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. These last 10 gaps, only one of them did we keep going up. The rest of them ended up with smaller gains or even losses by the time it was all said and done. So hence the filled-in candles that we've been getting on SPY. Not the most bullish of signs when you're going up with filled-in candles and a bunch of opening gaps that continue to get filled in. Usually you want to gap to the downside and then rally throughout the day instead of gapping. Which means most of your move is during the regular trading session instead of most of your upward moves being during the overnight trading session, where there's far less volume trading hands, and then all the selling occurs during the trading session. You want all the selling to occur in the overnight trading session where there's very little volume to support it. Regardless, the near-term line is back into the upper reversal zone. The momentum line's rallying, so a nice, good, strong finish to the week. Even if we didn't close above yesterday's high, it was a good, strong finish. Strong bullish posture, strong long-term market sentiment. Near-term line above 80, has been above 50 now for a good little run here, up to a new near-term high off of that near-term low point essentially that we got right there. So we're looking really good on the S&P. The Nasdaq's looking a lot better. The intermediate line's back above its market sentiment. It's gotten above 80 again. Very strong near-term line. Very bullish move on the momentum. And then the Russell 2000, intermediate posture strongly bullish. Market sentiment's rising again, getting close to being above 60. Because that's the one that's been the lowest, right? The Nasdaq is at 72, and the S&P, the market sentiment's still above 85. So the Russell's been the lowest market sentiment because we've been so flat for so long. Now we're up towards the upper end of this range, flirting with the 0% level, which is that high from back here on March 15th. So 3 months later, we might be pushing up to new highs. Near-term line had dropped down this week, as the Russell had a couple down days in the middle of the week. But as of right now would be a significantly bullish near-term low point, a lot higher than the last near-term low that we had here. So you would expect new near-term highs. So strong bullish postures to finish the week. Let's take a look at the weekly charts for all of these. And you can see also the near-term line on the weekly chart. Even though we get very, very small ranges, I mean, the weekly range was 41 points. Last week's range was 66. We were 48 over there, 127 and 180. So, I mean, that's about as small of a range as you can possibly. That's why the momentum line's not really going anywhere. But the near-term line is. The near-term line's very entrenched, very, very high levels. Continuing at this strong bullish posture on the weekly basis, even if that 30-week moving average is moving higher and higher, now up above the 38% retracement of this intermediate run, which is kind of rare for that to happen because it only happens when you have extremely long runs, and this is one of the longest runs that we've had on the S&P, especially in the last 20 years. If you take a look here at the NASDAQ 100, you can also see a very strong near-term posture, better bullish posture. The intermediate posture is still strongly bullish. And then finally the Russell, which has been the weaker one, its intermediate line and market sentiment are still bullish, despite the multiple weeks of just staying between 0 and 23%. And you can see near-term lines also. So, strong postures on a long-term basis and appearing like we're renewing, and you can see the 30-week moving average on the Russell, because again, the length of the run and the speed of the run, look at the 30-day average now is above the 23% retracement of this current intermediate rally. So that's quite the move to get above the 23% retracement. This one's above the 38 on the SPX, and then the NASDAQ, it's close to it. Remember, it has a new intermediate rally. It's close to its 23% retracement line. So, needless to say that we've had a pretty significant convergence with the 30-week moving average, where we've had this big gap. We're obviously converging. That kind of shows up here on this chart too, which shows how far away we are from the 50-day moving average. This is since 414 is when the NASDAQ finally broke above its 50. The others caught up later. But the NASDAQ broke above its 50-day moving average there on 414. Since then, you can see the NASDAQ peaked, and really all of these markets peaked on September the 2nd, except for the Russell. The Russell peaked in June, and then it was a NASDAQ-driven market. Then the Russell peaked again here, and it's had a big, strong run all the way pretty much up to February. And since then, it's been relatively weak, very, very weak. You can see we barely are above the 50-day moving average. The NASDAQ has been weak. The Dow has been really weak, and the S&P is half of what it was here in February. So you can kind of see where we need to kind of break out to if we're going to be bullish again. If we are indeed kind of maintaining, going from this level where we're at right now back up to 5%, then we need to get up to 5% and really start to pull away. Same thing on the 5% mark here, same thing on the 5% mark on the Qs, and it would be the 10% mark for the Russell 2000. We are obviously not there yet, so just kind of keep our eyes on next week to see if we continue to converge, which has been the recent trend, or if we break back out and get to 5. Because once we get to 5, it won't be, notice it doesn't get there and for only like 1 week and then break back down. It stays at 5% above it as they both start to rise. So that would be a very, very good sign if we were to get to that point. I don't expect it will, but it kind of shows, this is the grind. This is a reflection of the grind that we've been on, and kind of shows the weakness that we're on, as well as as I've shown you before on this chart. The S&P is just starting a weak bullish trend, getting above 50, getting above 1. For us to start a new intermediate trend, we need to get above 65 and above 2. And we're not there. That's the green dotted line there. That's the blue dotted line there. Obviously, we're not there yet. On the Russell, we are really, really close. We're just under 2. We're flirting with 65 there. On the NASDAQ, we are at just about 1.5, and we are at 58. So we're getting pretty close on all of these to starting new trends and kind of breaking out on new intermediate runs. Not quite there yet. So we'll see if we will get there next week, or if this is the peak, right? If we're going to hit some resistance with a lot of the weakness that we're seeing across other indicators. For example, one thing I talked about in my technical analysis class yesterday was the breadth indicators. And you notice that this is the number of stocks above the 50-day moving average since April, since it peaked here in April, right around mid-April there, the number of stocks above 90%, we are now down to 63%. So that's kind of reflective here on let's see, where did that chart go? I think I lost it. It's a reflection on this chart that I showed you before. This chart, if you go to just the 1 year from custom from 4/14 of 2000. The reason why I do this because I don't want it to in here. Let's also change this to 50 days. Sorry, how far away they are from their 50-day moving averages. Change this, and change this. You can see the reflection here. I don't know why it's not spreading out. There we go. You can see again how low we are, and again 414. Is it 414 of 2000? 20. Oh, here we go. There we go. So 414 of 2020. That's where we're at, and you can see since the middle of middle of April, that's where the number of stocks above the 50-day moving average peaked on the above the 50-day, and since then we've been declining on breadth, and you can see that reflected here too, that we're just not very far above the 50-day moving average, and we're getting more and more stocks that are actually below 100 stocks in this, according to these criteria, 100 stocks that are below their 50-day moving average. In fact, if you take a look just at the S&P 500 without these qualifiers, this is, we're looking at the 10-week exponential, we have 150 out of the 500 that are currently below their 50-day moving average. So you can see that we're just getting more and more stocks that themselves are in their own intermediate declines, even if the broader market itself is not quite there yet, right? It's not, I mean, obviously we're not there, we're not below its 50-day moving average either. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. Also hit that bell next to it. That notifies you when our videos are posted on YouTube. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, that you want us to, it tells us that you want us to do another video again tomorrow. So if you like our videos and you want to let us know, yeah, you can do it with one click right now with that thumbs up icon. If you don't like our videos, of course, you don't even have to watch. You don't have to click on anything. You don't even have to watch. So we do appreciate those who do click that like button. It tells us, like I said, it goes a long way. It lets us know that what we're doing here for free is valued. Also, comment down there. What did you get out of the video today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. You get access to our Market Outlook forum on our site for free, among other things. Be able to interact with other people that watch these videos regularly as well. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check some of these things out over here on the right, our Market Outlook Live videos. So every day I do the Market Outlook. I do a Market Outlook Live where I review all the old trades that we've been doing in these videos to see whether or not we should stay in them or get out. I also take a look at a new trade idea, and I put it on, the one that you'll see at the end of the video. I actually put it on before the market closes. Not this time. I had some schedule conflicts on Friday or yesterday. But for the most part, we put them on before the market closes, so people who watch the Market Outlook can't put them on until the next day. So you kind of get that benefit there. Also, you can see all of our upcoming classes that we have here. All of our paid subscribers get access to all those. Of course, our premium subscribers get access to it for cheaper. In addition to that, you also get access to a lot of premium tools and resources and access to our class forums. That we post our custom content And so that's all benefits for our premium subscribers. But our plus subscribers who pay month to month, a little bit more, but pay month to month, get access to all those classes and videos as well. Our premium subscribers can also get access to our Q&A sessions. Those are not trading rooms, but Q&A sessions. I just barely had one this morning with our premium subscribers, kind of to be able to coach on a more one-on-one type basis with any questions that you might have, obviously in a group setting. If you come down here, click on this heart, it opens up a new tab. Hit that like button right there. Also come down here, hit this thumbs up icon, opens up another new tab. Hit that like button there. Again, the more you do that, the more people will see our content. We appreciate those who do. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching. All right, let's get back to the charts here, and we take a look at the long-term chart for the S&P. And again, PPO very, very high, very strong levels of PPO. So again, it doesn't mean that we can't go up. It just limits how much we go up because of how strong the momentum, how big that gap already is between the 50 and the 200-day moving averages. We kind of start to slow down. The biggest momentum always occurs early, obviously, and then once you're really diverged away from each other, you start to converge with each other, which means the 50-day slows down while the 200-day still rises up pretty rapidly. That's generally the case. That brings this line back down. Doesn't mean we have to fall. It just means that we start slowing down, at least on a long-term basis, pretty considerably. Though you can see on some of these, you can fall pretty quickly and fill in that gap, that relatively large gap. Of course, this is one of the largest gaps that we've seen since the late 90s, is the largest gap, there we go, that we've seen. You can see all these green dots are all in the 90th percentile. We're currently in the 94th percentile, 97th since in the last 20 years. So very, very high levels of PPO that we haven't seen since we started. Like again, usually you get your strongest momentum at the beginnings, like when you're coming off of negative lows. So we've been off of a negative low for quite a while, and we're still maintaining some very strong momentum. You can see some other periods where that's happened when you start to converge. Like here, you did drop to zero pretty quickly with a drop below the 50. Here, we converged while you were still up above the 50. A few little pullbacks here and there, but for the most part, you were still above the 50 all the way up until that 2011 crossover. That's more typical, and that's kind of what I would expect would happen here. You might get a red arrow or two or three, but for the most part, you'll spend most of our time up above the 50 while the 200-day catches up, as the 50-day is slowing down. So that's kind of what we're going on. Of course, the Heikin-Ashi candles, we've been talking about the size of the Heikin-Ashi candle. It ramped up a little bit here this week. As you can see, we got up to 40 points. We were at, the last couple of weeks, we were at 34 and we were at 38. Now we're at 40. We're still less than 1%. So it's a very, very small body, which means obviously it means what is pretty obvious, that we're just not, there's not a whole lot of bullishness here. Like bigger bodies is what gets good bullish moves, and these are not big bodies at all, especially relative to the price. Again, to get 40 points back over here would be like, here was 40 points right there. The body was 40 points, but the mid of that range, or the open of that level, was at 38. So that was actually above 1%. Coming off of that little dip there, and a good rally. This is not above 1%, as we're just a little bit below now. So it's not every 40-point body is the same. Depends upon what we're relating, how we normalize it, what we're relating it to. If you take a look at the 3 green arrow chart, obviously very, very light volume. Is getting lighter and lighter. Another sign that we're not as bullish. You can see 3 green arrows though, from a 2-line standpoint. The divergence that we're getting, the blue line still rising. That means these lines are pulling away from each other. They haven't started to converge quite yet. You can see on some of the other indexes there was a little bit of divergence, but we're convergence, but we're diverging again on the Qs, and then the IWM we're actually starting to converge, right? The lines are starting, that they were pulling away, but they're starting to slow down in that, and stochastics is below its moving average. So we're not as bullish anymore on IWM as we are, say, on SPY, where we're still above the moving averages, and the histogram is still rising. We're still, and the MACD itself is still rising. Just barely, according to a very small histogram, but still rising. So still a little bit of divergence there. And obviously above the 8-day moving average on all those indicators. Other charts that we look at to confirm the directionality of this move, we're not above 30 on the positive. We're almost below 20 in the negative, which means the ADX is very low. In other words, no move. I already showed you the trend strength indicator. The RSI is flirting with 60, flirting with 100. It's up above 100 barely. It's not quite above 200, but it's above 100. It's above 60 just barely. The Qs are looking a little bit stronger from that perspective, and IWM also looking somewhat, again, flirting with 60. It had been looking better. A little bit of divergence right now on the CCI, as it's quite, having a hard time getting and staying above 100. So we're kind of like, again, flirting with on the cusp of this type of breakout move, but not really breaking out. And as we can see, it's kind of hard to break out when you look at these long-term linear regressions and we are so high up. There's the 10-year or the 5-year. There's our 10-year up above 1 deviation, and then you look at your 20-year, and we're up above 2 standard deviations on the 20-year. So we are very, very strongly bullish from that perspective, and it doesn't mean we have to drop. It just means the upside is limited. It's more limited when you're a lot further down. You can see coming off that Halloween low point to kind of give you a comparison of the potential move when we started this current intermediate rally, coming off this Halloween low point here. So that'd be 20 years, I think. We were at least below the first standard deviation chart, right? And that's when we started the current intermediate run that got us back up above the 2 standard deviations. So you can see why then we had more potential for upside movement than we have right now, where we are already up, so extreme as it is. So again, that's why it limits the upside. Now let's take a look at the intraday chart for SPY, and you can see the gaps, right? We're gapping up. We're gapping up practically every day. The only gap, though, that we haven't filled in has been this gap from last Friday, where we gapped up and then took off from the open and finished higher, coming off of, I believe, the jobs report on that day. That's the only one that we haven't filled in. And you can see that's where the point of control is for the 4-week period. So don't be surprised if we don't pull back. Remember, that acts as a center pull of gravity here, and thus we can really break out to the upside on Monday, kind of like with a breakaway type gap. Expect that to get filled. I don't expect that we'll get down to 415, though if we break 415, that's the point of control on the 90-day chart. That would say if we broke 415, that would be a significant breakdown to the downside. And obviously that this low point by next week, this won't be the low point anymore. The low point will be back up here to that 415 mark. So we'll be back to a very, very small range, which will open us up to be more susceptible for that Arun crossover, right? That Arun that we've talked about before, that bearish crossover, this type of crossover, which leads to weakness. It didn't lead to a pullback on the S&P, but it did on the NASDAQ, right? And same thing over here. That didn't lead to a pullback in the S&P, but it did on the NASDAQ. Here's what the NASDAQs look like. So, that is the intermediate pullback. And so you'd see, this break up to when the range gets smaller, it opens us up for the susceptibility for this to jump from low levels, spiking up to 100 when we do get a new 4-week low point. That's a pretty decent, and crossing above the green line, crossing which is the 4-week high, in the process of doing that. You saw the volume in the trading range as being very small for the week as a whole, but it's, every single day this week. The range here was 3 points and 1.85 points, and 3 points there. So 3-point range. Actually on Friday, excuse me, it was a 1.61 point range. You can't really see that very well because of this. Let me also log scale it. So here's that 1.61 point range there. Very small range, 45 million shares in volume. You can see what that's doing here. The ATR is getting extremely low. Now, last time it got extremely low, that preceded our intermediate pullback, right? It got down below 1%. It got down to a really low level here, on an absolute basis. So we're back down to this level again, getting to an extreme low. Are we preceding a new, with volume too, really dampening down, dropping like a rock. And you can see that showing up. I showed you this chart, but look at the historical volatility dropping like a rock as well. So that's going to drop down to these low levels, which again precedes these types of jumps higher. And the other thing too that precedes that are extremely low volatility on a relative basis, as well as really very small ranges, not so much on a on a daily basis, but the weekly ranges have been getting really small. Only 3-point range in the VIX in the last week, 3.5 points a week before that. So getting really, really small there. And then when you look at it on a monthly basis, from an options expiration cycle, you can see, you get long upper shadows typically, but we didn't get one this month. So this options expiration cycle has been a slow, steady, small downside move in volatility from May expiration all the way to June, without that long upper shadow that you typically get, that we got in January, that we got in February, that we got in April. So with the small range and the lack of the upper shadow this month, the expectation is something like this, that we're going to get a long upper shadow next month, which means more than likely early in the expiration cycle, so post June expiration, probably closer to the June expiration than July, we'll probably get a jump in volatility up to the high 20s, low 30s, and whether it's to 105% or not will tell us whether or not we are actually in an intermediate decline or still more of a soft and near-term exhale, where it doesn't really turn into anything more than that yet. Though, again, we've been going at this now since early November, so by June expiration we'll be 7.5 months along. So by the time we get to early July, we'll be nearly 8 months into an intermediate run with no pullback. Is an extremely long time. You think about, when you take your biggest inhales, what are the exhales like after you hold your breath for the longest possible time? That's kind of the expectation here coming out of this. All right, so to summarize the market outlook, obviously we're maintaining this bullish trend. It's grinding, it's getting grindier as we keep going forward. We're starting to see, not necessarily that we're shifting to bear mode, but you can see that we are definitely running out of gas, right? The bullish run is running out of some gas. Still got some gas left, obviously, but it's running out of gas. And also, too, as you'll see in other charts, there are signs that we're rotating towards more of a risk aversion trade. We've been slowly moving towards a risk aversion trade. And you can see some of those in the technicals that we just looked at. You'll see more of it here in the rotation and the different asset classes. But we are definitely getting far less bullish than we have been over the past, say, few weeks, as we've been really, really grinding higher, trying to keep going and keep this going for a lot of the weak hands that have been getting into this bullish run really, really late in the cycle. Eventually there won't be enough gas left to keep it going, whether that's next week or after expiration. Most likely it'll be after expiration, but that's something to keep an eye on going forward. So what do you think? Do you agree? That's my expectation. What do you think? Do you agree with that, or you disagree? If you disagree, let me know, especially in the comment section below, if you disagree, on why. What charts or indicators are you looking at that tell you why you're a lot more bullish than I am, that you think we are breaking out here to new highs and here we go, or that you're a lot more bearish than I am, that you don't think we're just getting an exhale, but you think that we are way too overvalued and we are really going to fall off a cliff. So what charts are you looking at that would suggest either of those situations that you want to share with our viewing community down below? All right, now let's take a look at what's driving the price action. Of course, we've been talking about the inflation trade for so long. Real estate jumping up, commodities, gold, all rallying higher. Bonds were weak, which means yields are up. The dollar is down. I mean, that's about as inflationary of a trade as you could possibly get. Let's take a look, though, at how this week traded to see whether or not anything might be changing from that perspective. See if there's any kind of rotation. If you notice, gold actually ended up falling by the end of the week. International stocks really struggling with their strong dollar. Commodity prices were strong early in the week, but then gave back some of those gains late. So really underperforming equities, with equities being strongly bullish up here. Interestingly enough, long-term bonds, with real estate still holding up well, long-term bonds did very well. And that's not inflationary, right? So it's a little bit of a sign of risk aversion to see, long-term bonds rallying to the same extent this week as small cap stocks and large cap tech, right? Which are all kind of finished up with similar returns by the end of the week. So that's not your typical, common pattern to see all those moving together. Look at long-term bonds breaking out this week above that 23% retracement, holding that breakout, and now potentially making a run towards the Fibonacci zone between 38 and 62, if not higher, back up to this 38% retracement zone of this longer term run that we had bounced, that we had broke through to the downside, hit the 62% retracement, and now working our way up. I think that's a very feasible target for where we might get to, if not, a little bit up to 149, 150 into that area. Very, very feasible target. In the worst case scenario, up into these areas here, 155 and a half to 158, but more likely into this area, where that 38 and 62% lines between 149 and a quarter and 150 and 3/4. A good chance that that's where bonds go into as we start a new rally. This, we did get a move into the upper reversal zone, the intermediate line, that actually had a cluster to help cement it, but that one, you notice the market sentiment line was still below 20, so it's kind of hard to get going there, and you notice it couldn't get going. It was sitting right at the 23% retracement. It was flirting with it, couldn't quite get through it. This time you got through it by a lot more, so a lot, much more significant breakout even without the cluster yet. And this time market sentiment now is rising and is pretty close to getting out of bearish territory, so getting above 40 and working its way back up. That's a very positive sign for bonds. Again, a very positive sign for bonds is not necessarily the most risky trade, right? That's more of a sign of risk aversion. You're seeing that as well in the Euro US dollar. So the Euro US dollar had been so bullish and trying to break out above that 38%. The Fibonacci, the intermediate lines was above in bullish territory, was above 80. But then we got this move on Friday where the dollar broke down to new lows for the past few weeks. And the intermediate line broke below its market sentiment line, still above 60, so it's still in bearish territory, but it's looking like it's got a chance to change that direction, having broken back down. Again, a rising dollar, even if it's only down to the 62% retracement level, a rising dollar or falling euro on this chart, again, is a sign of risk aversion, not necessarily a sign of risk appetite. And I think I showed you this before. The ratio chart of the Qs relative to IWM appears to be bottoming and starting to roll its way back up. This is another chart that was brought up in class by a student, XLY to XLP, again, as a sign of risk appetite and risk aversion. And you see that XLY had been so bullish. If I look at it on the weekly chart especially, and here let's go to a longer time frame for some perspective and change this to a 10-year. Oops. You can see the ratio of XLY to XLP is starting to roll over to the downside and getting a lot more bearish. That's a bearish sign of risk aversion again when you're trading, in this case, the 8 and the 17-day moving averages are trading, or week, excuse me, trading below the 30-week moving average, with the price below all of them, and the MACD falling, the PPO is falling, and the RSI is getting to lower levels than it hasn't been in for quite some time since the COVID low point. RSI also flirting with being below 50, which it hadn't been since that COVID low point. So lots of signs of rotation and risk aversion. You can see too a similar pattern. This is a good ratio to look at in terms of yield expectations. This ratio would go up when yields fall. Obviously it goes down when yields rally, and you can see it's gone down to a significant low point. But look at the divergence that's showing up on the MACD. The MACD has been rising with higher lows, with these slightly lower lows here. It's looking like we might be bottoming out. You can also see on the PPO as well, a very similar divergence. It looks like we might be bottoming out. Divergence showing up on the RSI, RSI up here, excuse me, and the CCI. See how everything's starting to turn up here, which is a sign that yields may be peaking and rolling over, which means that bond prices may be bottoming and rolling up as this ratio chart turns up to the upside as well. So now let's take a look at the sector moves for this week alone. So let's go back here and pull up the sector comparison chart just again for this week, and you can see the big outlier there in terms of real estate over the past 3 months. But here's the week that was, and you can see real estate still strong, healthcare obviously strong with the Alzheimer's news earlier in the week. But look at technology, discretionary, but look at utilities ramping up. So I mean, it looks bullish on the surface. Good strong moves in QQQ and IWM, and good strong moves in XLK and XLY and healthcare, and you think, okay, XLC even, we're looking pretty good. But on the flip side, we're also seeing signs of weakness with utilities doing strong and staples doing, starting to move up just a smidgen there. Real estate obviously as strong as it has been, and all these small sector weighted areas that have been doing so well since that September peak, since the NASDAQ peaked on September 2nd all the way up till, let's see, this would be September the 2nd of last year, all the way up to now. You can see they've been the biggest performers. Well, they've been the biggest underperformers this week. And again, when the market does move into risk aversion mode, you'll see more and more weeks just like that, right? Just like where we see here, let me go just this week. You'll see more and more weeks just like this, where these are the worst performers. And XLK and XLY might be positive, but they will be more likely they'll start to be negative, but they'll be outperforming these areas that had been so strong. We'll see more and more weeks like this where they continue to be really weak. That will be a sign of risk off, right, when they continue to do that. And this, like I said, within the surface of looking bullish, we're seeing signs of risk off underneath the surface, with utilities and bonds doing so well, and what were the leadership doing so poorly. All right, so for our trade idea of the day, I want to take a look at Qualcomm. Look at this sideways action Qualcomm has been in. Obviously, we're through earnings. Earnings was there in April, at the very end of April. The intermediate posture has been stuck between 40 and 60 after having a little bit of an intermediate pullback, couple of them here, intermediate pullbacks. Very similar to the NASDAQ as a whole. You can see very trendless. No trending going on here. Very noisy pattern actually below the Ichimoku cloud. If you take a look at the DMI, they're both between 20 and 25. Very low levels, well below 10 there. If you take a look at the Bollinger Bandwidth, it's also extremely low, relatively extremely low compared to the past year. So you can see why we're stuck in this point, because that's where the point of control is. So lots of volume in this area, setting up for the type of just sideways action. You can see the MACD also sitting right on zero, so no divergence going on at all. The blue line's not going up or down. It's just been as flat as a pancake. So that sets us up for the type of trade where we can say, okay, well, let's sell the 125, 120. We can come over here, buy the sell the 145, 150. Actually, excuse me, it's going to be the other way around. It's the 130, 125. I'll just look at my notes again. Selling the 130, 125 here, the 140, 145. That's where we were looking at. Depending upon where we get filled in here, here's where the trade ends up being. So let's go for full position size because we don't have to worry about earnings going into July. We set this up here, break evens, and set my slices. There's where my break even slices end up being. Let me show you where that is on this chart. You notice it's pretty much centered right on that tremendous volume area. Pretty much where we've been centered for the past few expiration cycles, with nothing yet to get us out of there one way or the other. If it breaks up to the upside, there's some concern, but there's a big resistance up there too. If it breaks to the downside, we don't have as much support, but remember, we're hedged for big downside moves and the broader market as a whole. So we'd be okay taking a loss on this to the downside because that's the side that's actually more hedged than the upside moves are. Very sideways action. You can see for the amount for the full risk, we're getting $500, which means that I can get my normal return that I'm shooting for, 334, for a lot less risk, 666. So that's what we're going to do here. We're going to put in a smaller and risk, and because it's a little bit more aggressive trade, I can risk less money. So if it does break down, and it breaks down faster than I can do something about it, if I can't get out with a $334 loss, then I know my worst case scenario is far less than my normal risk that I would put on for this trade. So we're going to right click, confirm and send, and put that into our market outlook category there for Monday. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Remember, all of our subscribers, even our free subscribers, have access to that. So open up any new threads there with any questions or comments you have. Reply to other people's threads based on their questions or comments. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, like us on Twitter and Facebook too, and comment on our videos. Have a great rest of your weekend, everybody, and we'll see you all on Monday.